Hi, everyone. Thanks for joining and welcome back to Wall Street Silver. Joining us today is Michael Pento. He is the president and founder of Pento Portfolio Strategies. Welcome back, sir.
Thank you, Ivan and Jim. Good to be with you.
Yeah, always great to have you back. Michael, we have a food crisis, a geopolitical crisis, and an energy crisis. Do you believe central bankers are panicking?
Well, I hope they're panicking. They certainly should be panicking, but they should have panicked a long time ago. I was watching the congressional testimony today with Powell and listening to the question. I don't know who's more stupid, the questioner or the one answering the questions. I mean, they're talking about, what can we possibly do about inflation? This was Elizabeth Warren. What can we possibly do about inflation? Inflation's all the fault of Vladimir Putin. Really? Yeah. Well, inflation was running at 7.5% year over year in January and then 7.9 in February. But there was no war until February 24th. So what caused inflation to rise almost to 8% before there was a war, before there was any kind of real crisis in Ukraine, food crisis, energy crisis, that's all. Well, it was the fact that the Fed's balance sheet went from 4.5 trillion before the pandemic to $9 trillion in just 2 years. It was the fact that we gave people $6 trillion of stimulus, which was almost all monetized by the Federal Reserve. The fact that we took interest rates to 0% and left them there for the better part of the duration between 2009 and 2022. Did it have anything to do with inflation, Ms. Warren? Of course it did.
I was listening to that same congressional. You're referring to the Senate testimony that Jerome Powell.
Senate,
yeah.
Senate,
And I was listening to it also Wednesday morning, and it was Senator Warren who was asking that. And I'm not a fan of Senator Warren. I think she's sort of loony, but she did make a good point of will raising interest rates deal with energy prices or food prices? And Jerome Powell's answer to both of them was probably not. And
he's a moron. He's a moron.
Do you agree with that? Energy prices?
I know what I don't. Oil is priced in dollars. Commodities are priced in dollars. If you depreciate the value of a dollar, commodities will increase in price. Yeah. And the converse is true. To sit there and claim that, energy prices increased and the price of copper increased and the price of wheat is going up and they're commodities and that's all the fault of Vladimir Putin invading Ukraine is asinine.
Yeah, it is.
We've destroyed the value of the dollar, not against the euro, not against the pound, not against the yen, because they're dealing with other morons with greater capacity to be ridiculous with their monetary policies, like Mr. Kuroda in Japan. Mm-hmm. Oh my God. Imagine having a 2.5% CPI inflation in Japan on top of an insolvent nation and pegging the 10-year note JGBs in duration 10 years at 1/4%. The dollar is losing its value, not against the yen, but against hard assets. I mean, was it the Vladimir Putin's fault that it cost 20% more year over year to buy a house?
Mm-hmm. Yeah.
No, it's your fault, Mr. Federal Reserve Chairperson.
Yeah.
It's your fault. I mean, you're the one who took interest rates to 0%. You're the one who increased the balance sheet from 800 billion to 9 trillion between December of 2007 to 2022. It's your fault that the balance sheet is still $8.9 trillion. If we have inflation at 8.6% and you're doing everything you can to get inflation down, that's what you say, Mr. Powell. Why is your balance sheet still at $8.9 trillion? Why? In June, almost July of 2022. It's ridiculous.
That raises a good point. June 1st was the date where they said months ago, back in March, April, May, that they're going to start aggressively, they used the word aggressively, selling off their balance sheet, as in not just buying more bonds on the open market, but actually selling into the open market or letting stuff run off, watching paint dry, whatever it is they're doing.
Right in the background.
If you look at the data that was just released in the middle of June,
it went up.
It didn't sell off anything. It went up. It didn't go up by a lot. It was like, I don't know, 10 or 15 billion.
30 billion. Went up by about $30 billion.
But they were supposed to be selling it off by 45 to 90 billion, something a month. I think the first couple of months, 45 billion a month.
Mhm.
So yeah, 47.5 billion in June, July, and August,
Yeah.
and then 95 billion come September. 95 billion come September.
So ignore what they say, watch what they do. Is that what we need to be doing right now?
I would say to you that you have to just watch the Fed's balance sheet, watch their actions. I don't know what the heck is going on with Mr. Powell. I really don't understand. If he really wants to tackle inflation, it's about money supply, bringing down the money supply. Well, the base money supply, which is Fed credit and physical currency, that's the building blocks of all other monetary aggregates, M1, M2, and M3, which we didn't only calculate M3. Well, if you want to actually tackle inflation, bring down the supply of money as fast as possible. That's what you should do. Right now, we're down from the peak about $40 billion from the peak. So let's hope that Mr. Powell does what he said. I believe him. I think he's going to do it. But I think, sometimes I wonder if the stock market goes down too quickly, maybe Powell said, "Ooh, let me see. Let me just, send a few dozen $1 billion to Jamie Dimon to gamble in the stock market, and let's not drain the balance sheet so quickly."
Well, that raises a good point. So you could already sort of hear it in the senators when their comments to Chairman Powell, where they are not necessarily worried about it. Up until now, all the political pressure has been on fight inflation. But now I'm starting to hear the politicians talk about maybe we should be focusing on saving the economy and not so focused on inflation, because inflation is Putin's fault. We can't do anything about that. We focus instead on the economy. That's more important, especially with an election coming up. Do you get the sense that the political pressure is shifting to applying pressure to the Fed to pause, or even pivot back to easy money?
There is a growing amount of pressure for Powell to ease on his, hawkish monetary policy stance. I don't think he will or he can. If inflation was, say, 4% or 5%, then I would say it's a possibility. But inflation is at 8.6% or headline CPI. It's not a viable tactic to take when you have such a gap between your target rate of 2 and 8.6. And the balance sheet that we've been talking about, if the balance sheet was closer to $5 trillion, then I could say maybe possibly he could ease up. But no, you have to drain trillions of dollars. I think it's at least $2 trillion from the banking system.
Jeez.
Before you can really claim that you've done anything to attenuate the supply of money. Powell is going to have to, because I think he assents to the notion now, and I completely agree with him. You can't have a viable, healthy economy while inflation is running attractive. You can't. But here's a better question for you. This is where my thinking is at. I believe by the fall, Powell is going to break something. I think the credit markets fracture completely by the fall, especially when he jumps to $97.5 billion a month of QT. And it is at that point, I think, the money market stops functioning. You can't float commercial paper any longer. Junk bonds no longer float freely either. And it's at that point, I think the stock market goes into full meltdown mode. So maybe inflation is at 7% year over year come the fall. But when Powell pivots, does he just stop draining the balance sheet? Does he lower interest rates? Remember, Powell wants to go to 3.25 to 3.5 on the Fed funds rate. The effective Fed funds rate right now is 1.6%.
Yeah, it's a long way away.
It's a long way to go to get to 3.25, 3.5. And he wants to get there, like I said, by December. So
100 basis point hike is coming, maybe, just to get there.
100 basis point hike. Well, you'll get the 75 probably in July. You get another quarter point in September, and then he'll look around and see what's going on. But listen, he's got a very difficult decision to make, because if he has to then pivot to back into QE and to reducing interest rates while inflation is still at 7%, he's got a real problem with his credibility. I don't think he can easily do that. So the best thing we can expect from Powell and the Fed, instead of riding to the rescue, again, like they always do, is to stop QT and to stop raising rates. But that will probably not be enough to save an economy that is already in a recession, but could be, waxing towards a severe recession or a depression by the fall. I mean, I just, here's one thing we didn't mention. Powell said the economy is very strong. I mean, you have to be a pretty good professional liar to say, or maybe you're practicing or auditioning for the Gong Show. The economy is very strong. Okay, Q1 was minus 1.4%. The Atlanta Fed has Q2 at 0.0%.
We're in a recession. We're in a recession right now.
For the first half of 2022, the economy has shrunk.
Mhm.
So how could the economy be very strong if we have a shrinking GDP, the consumer is racking up credit card debt to try to stay afloat, they're getting destroyed with falling real wages. Strong? Well, come on. Let's not try to be a comedian.
Well, that raises, we've interviewed you probably 3, maybe 4 times over the past year since we started Wall Street Silver. And I want to give you credit because you were calling this from our first interview with you, I think almost a year ago. You were calling this, that this is we're going to have a 50% type of correction or more. And we're well on that path. So I want to give you credit that on our channel, you were talking exactly what's happening now. You were talking about it 6 to 9 months ago. How are you looking at the gold and silver market? So, a lot of us in precious metals, we're hoping for a pause and then a pivot back to easy money because that's when gold and silver are going to launch. But you're from what I'm hearing from you, you're not as optimistic that that's likely to happen. What are you thinking about in gold and silver right now?
Well, first of all, let me thank you for mentioning that. It's important to understand that I haven't been calling for a 50% correction every year. I mean, I have an SEC registered RIA, and I was long in 2021. What I warned about and was profitable in 2021. What I warned about was 2022. It's exactly, the context I want you to understand. So I'm not one of these.
You're not a perma bear. You're not a perma bear.
I'm not a perma bear.
Yeah.
Not a perma bull or a perma bear. Now to your question about gold and silver. So what I'm most concerned about in the short term with gold and especially silver is when you have a liquidity crisis and you think back to 2008 or maybe early 2020. When you have a liquidity crisis, correlations go to 1. Everything gets sold in pursuit of liquidity. So think dollars and short-term treasuries. That's what I'm most concerned about as we head towards the fall. It's after that, if you get that liquidity crisis and Powell is forced to pivot, even if he doesn't lower interest rates, even if he says, I'm going to do something akin to what Japan is doing, we're going to cap long-term interest rates. That would be enough, I think, to send gold, especially gold, soaring to all-time highs. So I'm going to hold. I was at a max position in gold at the start of this year. I reduced it to a 5% position in gold. And I am going to greatly increase that position to gold after I see the manifestation of liquidity crisis. Because in a liquidity crisis, when you no longer have money markets function, then I know for a fact, Powell can talk about inflation all he wants. What he's most concerned about then would be to re-liquefy the banking system. Because after all, at the end of the day, that's what he's really there to do. He is the banker's bank.
That was 2018, right? When the high yield junk bond market went 6 weeks without floating any new issuance. And that is what forced the Fed to pivot back to easy money. So if the liquidity or if the wheels and gears of the bond market freeze up, that's what you're waiting for right now?
That's what I'm waiting for to increase my gold position.
Yeah.
Don't forget what happened in 2019. The same thing happened a year later when the repo market froze. So that's when he had to go back into QE. So I'm looking for something very similar like that to happen. Of course, there is a standing repo facility, but that doesn't solve all your problems. I mean, the repo facility takes treasuries. It doesn't take corporate debt and junk bonds. So that doesn't mean we're not going to have a problem. We're going to have a big problem in the money markets. They'll be clogged again. That's when he comes in and he says, okay, I'm going to have another facility that includes the loaning against against the collateral I just mentioned, junk bonds and commercial paper. And then I think gold's going to skyrocket because the market's going to understand that there is going to be no restrictions to the size of the Fed's balance sheet. It's going to grow inexorably.
we're not yet in a 2018, 2019 situation where the market has froze, the bond market's frozen, because there are still some high yield debts being issued, but it is way down dramatically from what people would consider normal already. So we're getting close to that point where the investment banks are not as willing to bring these new high yield debt to the market at this point, right? They're just, and what causes the banks to make that decision? It's that rates are rising so quickly right now that they just don't want to get caught on the wrong end of this trade and being stuck holding the debt.
They don't trust the other financial institution. They understand that these bond prices are going to tank. Well, who wants to get stuck with that kind of collateral? It's the same thing what happened in 2008 with the mortgage-backed securities, CLOs, CDOs. So I don't see any. I mean, we have. I think the number I think in my head is correct. An 87% increase in the amount of leverage in the system since 2008.
4,288 units, $335 million.
Boom! 87%. That's a tremendous amount of increase in debt outstanding. And the trading desks, the prop desks, have all been greatly reduced. So there's, they don't take inventory overnight any longer. So you're going to see the liquidity dry up very quickly. I would not be surprised if we see another liquidity crisis akin to what we saw in 2008, in 2022 in the fall. And that's what I'm waiting for to increase because when you see gold, I mean, gold will get sold, silver will get sold, everything will get sold except for dollars. Okay. The short-term treasuries and dollars will get sold. The only things that will not get sold. And then you understand completely what's going to happen next. The Fed comes in, they're going to vastly increase the size of its balance sheet. They're going to be taking on all of this collateral, this bad collateral, and gold is going to skyrocket.
Yeah, 2008 to 2011, gold was up like something like 120, 140%. It was like 800 to 1900. That was the move after that happened in 2008. And silver did that move, from 10 to 50 in the same time frame. So, if I don't know, you apply those same percentages, you're right. You're right. I think it could totally sell off in the crisis, in the initial panic, sell everything because everyone's got margin calls coming out the wazoo, but then gold and silver, launch at some point in the face of all this. But
from like August of 2008 to like say October of 2008, gold just got flushed down the toilet with everything else. I don't care if it was Walmart, utilities, corporate debt, whatever it was done, gone, because everybody wanted liquidity, and the shadow banking system was in desperate need to stay afloat. So they sold anything they had, and that precious metals. But that's a very temporary condition. So if you don't want to be cute like me, not aesthetically, I'm talking about managing money, then that's something you should try to pursue, or at least avoid getting caught in that downtrend. And I have the flexibility of doing it. So that's
no. Well, thank you very much, Michael. We appreciate you coming on our channel and sharing your experience and your outlook. You've been one of the, a lot of people come on here and make a lot of predictions and projections, but I just want to point out to the audience, you've been nailing it the past 6 to 9 months. Exactly what you've told us on our channel in your previous interviews has basically happened. So, kudos to you, sir.
Thank you again for having me on your fast growing channel. And I look forward to coming back on.
Thank you.